You know, we've been talking about baby boomers for the past couple decades, but today they're retiring in droves. And now they're facing that decision about no longer earning paychecks that they could use to buy into the dips when the stock market goes down. They've got to make these very important decisions about how to allocate capital. So they're 65 years of age, they've accumulated $1 million, and they begin to try to make a decision that they can only get right once. And the effect of having to deal with investors with this amount of capital and to make distribution decisions or allocation decisions that result in distributions is something we should do very, very thoughtfully. Because following traditional advice, if we listen to what the mainstream media says, if we listen to what no-load publications promise, the idea that somehow you can take that $1 million, pull out 4% safely, index it to inflation by 3%, and simply allocate the money 60% into stocks and 40% into bonds, it's all going to turn out just fine. The reality of it is, it doesn't always turn out fine. If you had been that retiree in the year 2000, today your $1 million would almost be approaching $800,000 in value. If you look at those drawdown moments in 2002 and 2008, you can see significant diminishment of their principal. But what if the notion of asset allocation can be expanded? What if it encompasses more than just public and private or public debt and equity instruments, but can also include the private markets in the debt and equity sequence? If you opened up your mind to those possibilities, you can see another story, a story of allocating about 25% of the capital to modified investments, investments that feature predominantly private equity and private debt strategies. And by introducing those strategies in the exact same period of time, from the year 2000 through 2013, with the same $1 million, the same 4% withdrawal, the same indexing for inflation, you see two dramatically different incomes. First, you can look at 2002 to 2008 and see a substantial change in the drawdown. You can look at the ultimate account value. Instead of being down nearly $200,000, you now have had some significant appreciation in the account. That an investor, that gap between what could have been and what is significant. And in my mind, that's actually the value of advice. And that's the value of financial advisors, and it's the value of firms that can bring these products to the marketplace.